Good evening, friends. Welcome to Nifty Indicators. It's easy to make money. Yesterday we discussed moving averages, but a couple of friends called and said it wasn't very clear. So I'm trying to do it again today. Sorry about it. Moving averages basically are lagging indicators, meaning they are based on past history, that is historical data, and from there we extrapolate to what we can expect in future. They are not predictive by nature, but we are trying to read something from the past history and use it. Moving averages are two types: simple moving average, that is SMA, and exponential moving average, that is EMA. Moving averages are dependable because they are not unnecessarily made complex. There is no paginative formulas. Take this, take that, multiply this, multiply that, divide this. None of those things. It is simple price action. The underlying closes at a higher level than the earlier days, and the moving average moves up, and underlying continuously closes lower than the earlier days, moving average goes down. And when the underlying is above the moving averages, it is bullish, and when the underlying start moving below the moving averages, it is bearish. As simple as that. Simple moving average is actually, it is simple. It is like any average. Last 10 days moving average we want to find out. We will take the total of last 10 days closings, sum it up, and divide it by 10. We get the average. That is a simple moving average, like any other average. Simple moving. If you want to find out 100 days moving average, 100 days simple moving average, then take the total of last 100 days closings, sum it up, and divide it by 100. We get 100-day SMA. As simple as that. Whereas exponential moving average adds a bit extra. That is, so as to give some additional weightage to the latest closing. That is, say, for example, if you are taking 5-day moving average, last 5 days, if X has closed at say 10, then the average is 10. Whereas very simple average is 10. Whereas last 10 days, it has closed at 10, and today it has closed at 100. Then what happens? If we take the simple average, 10 into 9 is equal to 90, plus add today's 100, 190, divided by 10, it is 19. Whereas when we are giving additional weightage to today's closing, then it becomes a little higher. What happens is, the weightage we are giving is, that is multiplying effect we are giving is, for 10 days, it is 18.18% higher. because multiplier we are using is 2 divided by 10 plus 1 is equal to 2 divided by 11, that is 18.18. So it has that much additional weightage to the latest move. That's all. That is the exponential moving average. In fact, we can use everywhere where we are using EMA, we can also use SMA and still get almost correct effect. But EMA, as they say, both are right, but EMA is a little more right. That's all. Now, EMA calculation has three parts. First step is calculating the simple moving average. Why? Because wherever we are starting the EMA, we need to give the first EMA. We have not yet started, so how do we give EMA? That is why we need to have the earlier SMA. That is why we need to calculate the earlier SMA and use that as the first EMA. Secondly, we need to calculate the weightage multiplier for EMA. In EMAs, we always apply multiplier weightage. The weightage multiplier. That we do by dividing 2 by the sum of number of days plus 1. That is, if we are doing it for 10 days, 10 plus 1, 2 divided by 10 plus 1, 2 divided by 11. If we are doing it for 100 days, we are doing it 2 divided by 100 plus 1, that is 2 divided by 101. That's all. That is how we give the multiplier effect. Then the last part is the calculation of EMA using the formula. That is multiplying the remainder of today's close less earlier days exponential moving average by the multiplier and add this product to the previous day's EMA. That is smoothing the effect of EMA. That's how we calculate the EMAs. Now that we have seen what is EMA, we have to see where we can use. SMA, for example, is used, 20-day SMA is used for middle Bollinger Band, etc. EMA, we use it for EMA cross, the basic by default 926 EMA cross. Then we take it for crossovers, 2050 crossover, 2000 crossover, etc. Most important EMA we use for MACD, 26 by 12 MACD. We will take it up tomorrow, MACD. And EMA cross we also use for golden cross and death cross, which is very, very important, especially for long-term investments. We'll take it up further tomorrow. Till then, take care. God bless.